And Stephen Schorck, the president of Shorck Group, says that energy prices ended last month and began this month on an ugly note. He joins us now from Philadelphia to discuss his thoughts on oil inventories out this morning and his bearish outlook going forward. Stephen, great to have you.
Thanks very much, Lori.
So why are oil prices going down when forecasts for the economy seem to be going up?
Well, it's this kind of the same situation we had in the second quarter when prices began to double and the economic headlines were not so great. The market always has a notion to zig when everyone expects it to zag. We have to appreciate, yes, the economic headlines are great, especially on the manufacturing side. But again, the consumer is under a terrible strain at this time with mounting credit card bills, mortgage delinquency rates, mounting unemployment, so forth. It's August. We're 1 week away. Actually, we're just a couple of days away from the Labor Day holiday. The end of the driving season is here. In the next 2 weeks, gasoline demand is about to ebb. Refinery demand for crude oil is about to ebb as the refineries go into their fall maintenance schedules. So there's a lot of demand that's about to go missing in the next couple of weeks. We got up to $75. We actually touched it briefly last week. We came off. The bulls couldn't hold on to it. Bottom line is, if you're going to see weakness in crude oil, and I think we deserve to see a little weakness in crude oil given the lack of demand in this market, you can see further weakness, I think, down at least, well, we're now basically in the mid-60s. If we can't hold support here, I would look for a flush back down to 60s and even back below $60 before it's all said and done.
Well, that's the interview. You just summed it up for us, Stephen. Thanks so much. Have a nice day.
Hey,
One question.
Thank you.
All right, I'm just joking. You know, we did have the OPEC cartel coming out, moving to keep production levels stable. Let's talk a little bit about OPEC. Probably not a surprising move, but where does the cartel go from here? And I'm curious, Stephen, what your view of OPEC is. Is it as influential now that we've been through this crisis?
Oh, it's absolutely influenced. I mean, when you talk about one group, and let's be careful, they don't like them. They don't like you calling them a cartel. They are a producer group.
I didn't know that.
Oh no,
pardon me.
That's I learned my lesson there. No, they look, four out of 10 barrels that they have control in. So obviously they are a power in this market. Now what happens is their power is greatest when oil prices are at their cheapest. So in 1999, when oil was at $10, at the beginning of this year when oil was at $30, that's when you saw the greatest cohesion amongst the group to rein in production. But every $10 this market ticks up, that cohesion weakens, and you get a lot of slippage from the group. With regard to next week's meeting, I would expect to see the status quo. I was at the meeting in March when oil was in the $30 range. Since then, prices have doubled. The economic picture has certainly improved. So their next move will be to pull barrels off the market. But I don't expect to see anything at this time. They don't want to kill whatever incipient demand is afoot right now. They don't want to be seen as the bad guys. But I assure you, if the dollar remains as weak as it is, you will see greater cohesion, and you will see in the near term, probably at the March meeting, that OPEC will move to take barrels off the market.
Stephen, we have about a minute left. What's driving this oil market right now? Is it fundamentals or is it the overall economy?
I think it's the perception. As with anything, perception trumps reality in this market, and it is certainly the perception now at this point. If you are going to see weakness in the market again, Mark, we're at the end of the driving season. We are months away from the heating season. Demand
but we're also, Stephen, coming into hurricane season. No? How do inventories look? Yeah. We're okay?
I mean, we are swimming in inventories at this point. 343 million barrels of oil. That's well above the third quartile over the long-term range. So we have enough crude oil. We have distillate fuel, diesel fuel, heating oil at the highest level since Halloween 1983. And gasoline supplies are still above the 200 million barrel mark, which is a big psychological number. Yeah. So there's plenty of supply in the market, and we are going into a low demand period. If you're going to see weakness in prices, the time is now.
Stephen, what about that BP news that we heard today about what they're calling a giant discovery in the Gulf of Mexico?
Hey, economics 101, Mark. You make the prices high enough. High prices are the best cure for high prices. All of a sudden, no one's talking about peak oil anymore. Chevron had the discovery in 06. BP, this is a great discovery. We had the 2P discovery off the coast of Brazil a couple of years ago.
Is it a big enough discovery to impact the price of oil?
I mean, long term, what it's going to do is it's going to take some of the volatility out, because now that we have this potential, look, this BP oil, we're not going to see probably for another 5 or 6 years. But as long as the market knows, as long as the perception is that there is that oil in the pipeline, it will help quell volatility as we go forward.
Stephen Shorck, president of Shork Group, joining us from Philadelphia. Stephen, as always, thanks.
Thanks, Mark. Thanks, Lori.